Well, thank you very much for braving the winter roads. And I know it's Minnesota, but still, it was quite a drive here. Thank you for being at Conversations with the Fed, an evening with Narayana Kocherlakota, President of the Federal Reserve Bank of Minneapolis. And I'm Chris Farrell, economics commentator for Minnesota Public Radio and Marketplace. So, a brief introduction, very brief introduction. Kocherlakota attended college at Princeton University. He earned his PhD in economics from the University of Chicago. He has been a professor at the University of Minnesota and Stanford. He became head of the Minneapolis Fed in 2009, and during his tenure, he has been a voting member of the Rate-Setting Federal Open Market Committee twice. So he's going to start off with some introductory remarks, and then we'll get to your questions. Please.
Yeah, thanks a lot, Chris. I want to echo Chris's thanks for coming out here tonight. Certainly, I made my way here from even just a short distance from Golden Valley, and it was yeah, the roads are definitely treacherous. So thanks a lot for joining us here tonight. The plan is for us to spend the bulk of our time answering your questions, but I thought it might be informative for me to kick things off with some remarks about monetary policy. So I'll begin with a discussion of monetary policy objectives, and I'll describe how the Federal Reserve has done in terms of relative to those objectives, in terms of performance relative to those objectives over the past 3 years. Then I'll turn to a brief analysis of what I anticipate will be appropriate monetary policy choices in 2015 in terms of achieving our objectives. Throughout my remarks tonight, when I answer your questions later and talk to Chris later, please keep in mind that I'll be expressing my own views, and they are not necessarily those of others in the Federal Reserve System, especially my colleagues on the Federal Open Market Committee. So I have the privilege of serving on the Federal Open Market Committee, which is the monetary policy making arm of the Federal Reserve. And at FOMC meetings, we decide on the level of monetary stimulus for the economy. For now, I'm not going to get into too many details of what the term monetary stimulus means. I'm sure we'll talk a lot more about that later. But except to make two high-level points. First, when the FOMC changes the level of stimulus, our actions tend to push inflation, that is the rate of growth of prices, and employment in the same direction. If we increase in stimulus, that pushes upward in employment and prices. And if we decrease stimulus, that puts downward pressure on both inflation and employment. So second, the FOMC's actions only affect inflation and employment with a lag. That's usually thought to be 1.5 to 2 years. So that means when we're making decisions, we have to be looking forwards in time to decide whether we're making the right decision or not. Now, what are we trying to achieve by varying the level of monetary stimulus? Congress has charged the FOMC to make monetary policy to promote price stability and to promote maximum employment. This is sometimes called the dual mandate. The FOMC has interpreted that first goal of price stability to mean keeping inflation close to 2%. The FOMC's job is to vary monetary stimulus over time to meet these mandated objectives, keeping inflation close to 2% and promoting maximum employment. Okay, so those are our objectives. What I want to do now is turn to an assessment of how we've done, how the FOMC has done over the past 3 years relative to those objectives. And I'll start in terms of showing performance relative to the maximum employment mandate over the past 3 years. So this is the unemployment rate. It's the best known measure of labor market performance. And if you go back to December of 2011, which is the first observation you see on this chart, the unemployment rate was 8.5%. Since that date, the unemployment rate has fallen to 5.8%, and we'll get a new reading on it tomorrow morning from the Bureau of Labor Statistics representing what the unemployment rate was for December. I think the fall was especially rapid over the course of 2014. But the unemployment rate does remain elevated compared to the FOMC's assessments of its long-run value. So you look at this picture and you want to ask yourself, should Americans view this performance with respect to the maximum employment mandate as being satisfactory? That's a hard question to answer for a couple of reasons. But just based on this picture, I should say. First, there are other labor market metrics besides the unemployment rate. And many of these other labor market metrics depict less labor market improvement in the past 3 years. The one thing I will emphasize, though, is all of these metrics show that the labor market improved markedly in 2014. Second, so the first thing is we have a bunch of metrics and they don't all show as much improvement. But second, regardless of how much we believe labor markets have improved over the past 3 years, we're still left with the question, would it have been appropriate for the FOMC to make choices that would have facilitated even faster growth in employment or faster improvement in labor market conditions? To answer that question, whether or not it would have been appropriate for the FOMC to provide even more stimulus to make this decline faster, we need to turn to the behavior of prices, the other mandate. So as I noted earlier, the FOMC has translated its price stability objective into keeping the rate of increase in the price level, the inflation rate, close to 2%. Even more specifically, the FOMC uses what's called the Personal Consumption Expenditures Price Index, the PCE price index, to calculate inflation. It's a little different from the CPI, the consumer price index you more usually emphasized in media coverage. But this is a measure of inflation that captures the rate of increase in all of the prices of all goods and services, including those related to food and energy. Okay, so here's a graph of how PC inflation has behaved over the past 3 years. Okay, again, starting in December of 2011. This is looking, when you see an observation on this picture, say 1.2%, that represents how much prices have grown over the past year, so the rate of inflation over the past 12 months in particular. Now, there are 3 main takeaways from this picture I think that you should keep in mind. First, PCE inflation has averaged actually less than 1.4% over this time period. This is well under our 2% target, which is depicted there. Second, and you can see this very clearly on the picture, PC inflation has been below 2% for a long time, over 2.5 years. Finally, if you look at last year, there was very little pickup in inflation last year. So those are the 3 takeaways. Below average for 3 years, well below target really consecutively now for over 2.5 years, and a little pickup in inflation. Now, you cannot expect, the American public cannot expect the FOMC to hit its inflation target every month. We get hit with shocks that we can't offset readily. But 2.5 years is a long time to be under target. The FOMC's performance in terms of its price stability mandate can be summarized pretty simply. The committee has not provided sufficient stimulus to hit its inflation target. Now, this persistent underrun of the inflation target creates a risk to the credibility of the committee. For monetary policy to be effective, it's critical that investors and other members of the public believe the FOMC is in fact aiming at 2% inflation and not at some higher or possibly lower number. Persistent deviations from that target may weaken those beliefs. Okay, so we say we're aiming at 2%, but if you are looking at this picture, you may grow to doubt that we actually are aiming at 2%. Recently, there have been signs of exactly this kind of reduction in FOMC credibility in declines in longer-term inflation expectations based on financial market data. So far, the FOMC has largely failed to take substantial policy action in response to these declines in market-based measures of inflation expectations. And that lack of a response creates additional downside risk to the credibility of the 2% inflation target. So I close my discussion of price stability by circling back to a question about the employment mandate that I posed earlier. Should the FOMC have stimulated more rapid improvement in labor market conditions? Now, this data and inflation suggests an answer to that question. Recall that I said that monetary stimulus pushes upward on both employment and prices. If the FOMC had provided more stimulus, the FOMC could have generated at least somewhat faster improvement in labor market conditions without having created undue inflation, because we have inflation running below target. I'm sure that this faster improvement in labor market conditions would have been welcomed by the American public. So because inflation is running below target, the FOMC potentially could have provided more stimulus that would have helped unemployment fall more rapidly without generating undue inflation. So even though the unemployment rate fell, it seems that there was an improvement opportunity. Given how low inflation was, the FOMC could have and should have facilitated even faster employment growth. Now, I've talked about the past, FOMC performance of the past 3 years relative to the FOMC's objectives. I now want to turn to the question of how I believe monetary policy stimulus should evolve over the coming year, 2015, so as to best achieve the FOMC's objectives. I'm going to focus on the particular issue of how the FOMC should adjust the target range for the Fed funds rate, the short-term interbank lending rate. Now, as has been true for the past over 6 years now, that target range is currently set between 0 and 1/4 percentage point. Very low, obviously. And the main issue facing the committee is this: should that target range be raised soon? My own current assessment is that, well, it'll take a few years for inflation to return to 2% from its current low level. Inflation tends to be a very persistent process, and to use the technical language, it's hard to turn. And so getting it back to 2% is going to take some time. As I noted earlier, monetary policy affects prices with roughly a 2-year lag. So if the FOMC were to raise the target range for the Fed funds rate in 2015, that's going to even further slow the pace of the slow recovery in inflation back to 2%, and it would increase the risk to the credibility of the FOMC's inflation target, in the sense that the public would increasingly perceive the committee to be aiming at a lower inflation rate. So given my current outlook for inflation, which is inflation is not going to get back to target for a few years, I would say the FOMC can best achieve its macroeconomic objectives by not raising the Fed funds rate target in 2015. All this is based on my current outlook, of course. If my outlook changed, then my recommendation might well change. Would change. Now, deciding not to reduce stimulus in 2015 would also be appropriate in terms of the employment mandate. I've talked through everything in terms of the price stability mandate so far. But increases in stimulus push upward on unemployment, and employment increases are always consistent with the pursuit of max employment that Congress has mandated for the FOMC. Thank you very much for listening to my opening remarks. But now let's turn to the real focus of this evening, your questions.
You're leaving us. I mean, how can you?
Well, it was very difficult. I mean, this has been, without a question, the most rewarding job I've ever had. I took it up in October 2009, and I came to the job out of a sense of purpose and mission. That our country was going through what I perceived to be, and I think many people perceived to be, an economic emergency at that point.
Yeah.
The unemployment rate was 10%. Financial markets were still struggling to recover from what had been a deep financial crisis. And I just thought I had worked as a professor for over 20 years, and I thought I had accumulated knowledge that could be of help to my country in that time. You know, as fortunately, I think, as I've just mentioned, I think we have some room for improvement still, but really that sense of emergency has eased at this point. And as I evaluated where I stood at the end of my term, which is coming up at really almost over a year from now,
right.
I thought it was a good time for me to seek new opportunities.
As you mentioned, you were an economist before you became a central banker, and you're a macroeconomist, a well-known macroeconomist. How has being a central banker and participating in as a voting member and also just all the discussions, how has being a central banker affected the way you think about economics?
It's affected me a lot, and I think that it's given me, you know, my work as an economist was, I think it was generally accepted as being pretty abstract, and meaning that I often abstracted from a lot of institutional details, I would say, in a lot of my work. And I think there's a role for that. Don't get me wrong. I think I'm not trying to criticize, to be too critical of my past work, but I have a really more of an appreciation for the role of a lot of the institutional details that we grapple with on a meeting-by-meeting basis than I did coming into the job.
Okay, so let's take a question from the audience.
Yeah, sure.
Are the Federal Reserve's dual mandates of stable prices and full employment contradictory?
I don't perceive them to be contradictory. If we can get inflation back to 2% and keep it at 2% over the longer run, we'll be at max employment. Well, there might be deviations on an ongoing basis. Inflation will fluctuate around 2%. Employment might fluctuate around its what we might perceive to be a maximum level. But it's in the long run, if we get to 2% inflation, we will have also maximum employment. I think what's hard to know, and what we grapple with on an ongoing basis, is how do we know where maximum employment is? So I had shown that picture of where the unemployment rate was coming down. Where is it going to go in the long run? Well, the Federal Open Market Committee has provided assessments of that, but those assessments change over time. My own assessment of where we're going to go in the long run has fallen by, I think, about 1.5 percentage points over the past couple years. And, you know, given how low inflation has stayed, where we are with the unemployment rate, there's reasons to think that maybe the long-run level of unemployment could be even lower than what the committee is currently assessing it to be, which is somewhere between 5 and 5.5%.
So that touches on one of the big debates that's been going on probably since the creation of the Fed in 1913, but has flared up more recently with, as a central banker, do you follow rules? So you have a 2% target rate, or do you follow discretion where you make more of these judgments? And sometimes it seems like it's very easy to have a rule, or it almost seems like there is a rule when it comes to the price, when you have a 2% target rate. And we get a little bit of discretion here over on the employment side. And there's a lot of people in the economic fraternity are saying, we want you to follow a rule, and then the markets know how to behave, business knows what to expect, and it's a rule, and other people saying, wait a second, this world is a mess. Yes, it's equilibrium when you're doing a model, but we're living with a lot of disequilibrium, and we need a little more discretion.
So yeah, let me talk a little about this question of rules versus discretion. And people use those terms in lots of different ways, but I'm going to try to talk about it in a very specific way that a lot of observers would like the Fed's choice of its target range for the interest rate to follow a very pre-specified connection to what's happening with economic conditions like unemployment and inflation. And so this is not really about having a fixed goal. This is really about how you're changing your instrument, what your instrument, your tool you're using to get to the goal. And my own vision is this is not going to lead to good outcomes, and it's because how you use your tool to get your goals will change over time. And in particular, when economic conditions are very poor, you might have to use a lot of accommodation. But your unemployment rate and inflation rate might not be enough to tell you how much to use. And right now, for example, there's a lot of demand for American bonds, treasuries, coming from overseas because people are nervous about the future. There's a lot more demand for that than you would have perceived as being true given our macroeconomic conditions. That pushes down on the interest rate that we have to deliver in order to hit our target goals. So I really think it's like, I think of us, the FOMC, as working for Congress, and really working for the American people, but Congress is the representatives. And the question is, should you be telling your employee what to do with their, on an everyday basis, or simply saying to them, here's some objectives, you go out and do what's necessary to hit those objectives? I think that second approach is going to lead to better outcomes because it's hard to know up front what we're supposed to be doing in order to hit those objectives. If we try to tell us ahead of time what to do with the interest rates, I don't think we're going to be able to hit 2% inflation and maximum employment as effectively.
Okay, so the next question is QE. And how will QE be unwound? And by the way, QE is shorthand. That's for quantitative easing. And specifically, what happens to funds from a bond purchased by the Fed when the bond matures?
So I'm going to back up. I mean, this is a sophisticated audience, so I'll probably go over some ground that is familiar to all of you, but just to level set us all. And that, by the way, is a term that I learned in my 6 years at the Fed, is the term level set.
Okay, that's a new one. I've got to research this one.
So during the course, beginning really even as early in 2009, the Federal Reserve, because our interest rate tool had gone to zero, we couldn't lower it anymore in order to provide stimulus, the Federal Reserve sought other forms of stimulus. And what in particular it did was to buy longer-term assets that had been either were issued or backed by the U.S. government, mortgage-backed securities and long-term treasuries in particular. By buying these longer-term assets, there's extra source of demand for these instruments, pushed upward on their price and down on their interest rates. So you're pushing down on long-term interest rates. This is to try to provide another form of stimulus to the economy than the one that was just because we couldn't do anything with the short-term interest rates. And so you go back to September of 2008, our balance sheet was about $800 billion of assets, and there were very few excess reserves in the banks. The banks were basically holding enough reserves to back up their deposits according to law. Now we have over $4 trillion in assets that we've bought, and those now the banks have a lot more excess reserves. And people are concerned that these excess reserves will somehow get into the economy and cause inflation. And that would have been more of a challenge had we not had another tool that was given to us in October 2008 by Congress, which is the ability to pay interest on reserves. So when conditions warrant and the economy gets strong enough, and we're worried about inflationary pressures, we can raise the interest rate on reserves, and then the banks they'll keep the reserves with us as opposed to trying to lend them out. But now the long-winded way to come to the question, which is what's going to happen to all these $4.3 trillion. So right now what happens, some of these bonds are maturing every day, and what we're doing right now is reinvesting those payments that we're getting. So we're keeping the size of our balance sheet constant at $4.3 trillion. Up through most of 2014, we were adding to our balance sheet by buying new assets. We stopped doing that in October of 2014. But now we're still keeping our balance sheet constant. How do we unwind these asset purchases? I think the main thing is our ability to do monetary policy is really independent of how many assets we hold. And it's because we can pay interest on reserves. No matter how many assets we hold in our balance sheet, if the key is what is the Fed going to do with interest rates? As long as we raise interest rates on reserves in a timely enough fashion to control, we'll be able to control inflation. So it's not a question, can we do it? It's just a question, will we do it? And that's the usual question.
Right. So with what we know now, looking back, because obviously there's a lot could happen going forward, right?
Yeah.
But with what we know now, did QE work?
This is I think it worked. I think it did work. I think the assessment of this is going to be an ongoing process, which is why I hesitated. Based on what I know right now, I think that I'll divide it into two pieces. One is the question of buying assets, did the Fed effectively lower longer-term yields? That was actually a question that was up in the air. So there was a lot of academic work that suggested that theoretically the Fed would not have the ability to do that. I won't get into details of why, but that I've been convinced by the empirical, and I actually came to the question of, I was actually pretty skeptical that we could even do that. But the data seems relatively clear to me that we were able to do that. So we were able to lower long-term yields. Then another question is that lowering of long-term yields actually stimulate the economy, and by how much? I think it did provide stimulus to the economy, but I think the question of how much is harder to know at this stage. I think it was on net, it was a positive thing for the Fed to be doing to help stimulate the economy in a time of need. But boy, I wish we could have cut interest rates. that would have been, I would have much preferred to have been in that position. Yeah.
Now, what about Europe? Because Europe, Europe, not the core rate, but the official rate of inflation, and core rate is
stripping food and energy.
You strip out food and energy. You strip out life from the measure, and but the overall is in deflation, and there's a lot of calling for Europe to embrace this quantitative easing.
Yep. Yeah, I think so. The European situation, you described it very well, Chris. Inflation expectations have drifted down for them, and inflation itself is running very low, and their interest rates are, as ours were, at very low levels. So difficult. I think they've actually have negative interest rates, which is more than we ever chose to do, and so there's a lot of conversation about using asset purchases there. They face more legal. They have a different kind of legal environment. They've got this European Union. There's a lot of countries there, and so I think creates more challenges for them to be able to figure out how to make things work along those lines than for us. When I look at Europe, one of the rules I try to live by is I don't want European policymakers criticizing us, and so I don't go around criticizing them. And so my main takeaway from Europe is, boy, however it ended up there, I don't want to end up there as an American policymaker. So this is why I've been talking in the past year about how worried I am about the low inflation, the slide in inflation expectations. You know, we're not Europe by any means at this point, but you want to do everything possible to prevent yourself from getting in that situation.
Well, that leads right into the next question, which is, what economic conditions would have to occur to convince you that raising rates would be prudent?
Yeah, I think that that's a great question, and it's one that it's exactly the right question, really, is what conditions should you be seeing? Too often the conversation is about what date will you raise rates? That's often a question I get. That's the wrong question. This is the right question. So with that said, what am I going to be looking for? So right now, despite the fact that Chris criticized core inflation just now, I will be paying a lot of attention to core inflation. And the reason I'll be paying a lot of attention to core inflation, which strips out food and energy goods, and the prices of energy goods and services moves a lot around a tremendous amount. And so it's really core is more predictive of where inflation is going to go as opposed to where it is right now. Can we actually have a slide on core inflation? Can we pull that up? That will be a sign to me. If we start to see core moving up sharply towards 2%, that will start to be a sign. Now the red line, you see it's less wiggly than the blue line, because the blue line is being driven around by the price, mainly the price of gasoline, but also the price of food. And gasoline and energy goods and services, well, we just saw, I don't have to explain this too much, because we just saw in the last, since September, the price of a barrel of oil has fallen from $90 down to below around $50, right? We don't expect it to keep going. So we shouldn't be using that as a predictor of where inflation is going to be, the rate of change of prices. So that's why we strip that out, and that's why you get the wiggles in the blue line as opposed to the red line. Even if you look at that red line, I don't see that red line making a sharp, moving smartly back to 2% at this point. But I'll be looking for that. That'll be one thing. Another thing I'll be looking at, we don't have a picture for this, is what's happening to wages. And wages growth has remained quite temperate, moderate, slow, sluggish, whatever term you want to use. Is starting to see maybe just a little tish upwards in the past 2 quarters of data. But I would say now, it's by historical standards, wage growth is also running around 2%, which is around our inflation target, and you actually want to build in some room for productivity growth. So that's something that, so those are the two of the ingredients I'll be looking for, is what's happening with wages and prices. I will have my caveat up. I should add a third thing, which is on the measures of longer-term inflation expectations that I mentioned earlier. So if you look at financial market data, people are implicitly placing bets on what the inflation rate is going to be, not just next year, but from 2019 to 2024, 5 to 10 years out. They're betting more and more increasingly that inflation is going to be low over that 5 to 10 year period. That's bad news for you. That seems to indicate that they're thinking, boy, the FOMC is not aiming at 2% inflation. I want to see that moving up as well. So those are 3 things that I think are very important. Core inflation moving back, starting to see more wage growth than we've seen, and seeing those longer-term measures of inflation expectations starting to move back up towards where we would like to see them.
So on wages, and drilling down a little bit into Minnesota,
Sure.
CarMax is moving into Minnesota, and they're going to hire 75-plus people. And something I haven't seen in a long time, there's a hiring bonus, $1,500 to $5,000 for mechanics, so they sign up by a certain time. Are we starting to hit a tipping point here in Minnesota?
So I think that we have been surprised, frankly. Unemployment rate has gone very low in Minnesota, and we have been surprised by how little wage pressures we've seen so far, given that. Generally we would have thought we would see more, and I think that's good. This is good news. Boy, we can have unemployment rate below 4% without seeing wage pressures. Back when I started this job, there was a lot of concern that, some of it I expressed myself, that the events of the recession had caused permanent scarring to the labor force, which meant that we couldn't get unemployment rates down to 5 or 4% without seeing wage pressures and then inflation coming from that. Well, that's not been our experience here in the 9th District, and our labor markets are much more healthier than the nation as a whole. That should give us a lot of confidence. But eventually, conditions will improve sufficiently that we should see the demand for labor pushing up on wages, and that will, I think, also start to trickle into inflation. Inflation in the Twin Cities, even though our unemployment rate is close to 3%, is actually the last measure we have is still and the consumer price index is below 2%. So still not really much signs of wage or price inflation here.
So here's a question, and I imagine you get a lot. I know I get from my mom. Right. Many seniors supplement their Social Security income with interest from CDs. And with interest rates being low for so long and the outlook that you're portraying, does the Fed have any serious concerns about standard of living as seniors? Because, these days you're just getting so little from their savings.
So, I went. I've got this question a lot, as you suggest, and it is a real. So let me talk about the reality of it, but then I want to talk a little bit about data as well. So the reality of it is that people are in the situation described. They're living on CDs. They might have longer-term bonds that pay off, and those longer-term bonds had pretty high coupons. And wow, now suddenly they have to put them they have to find some instrument to put them in, an asset to put them in, and there's nothing out there that's paying a high yield. And this is definitely a challenge. Our objective in the Federal Reserve is to get inflation at 2% and to promote max employment. And the tools we use to achieve that goal definitely have distributional consequences. People who are in the position of being in what I would call a short-term saver, trying to roll over their assets from CD to CD, they are going to be challenged by the low interest rates we provide. The reason we have to keep interest rates low, we're not doing it to punish seniors. We're doing it in order to achieve our economic goals. And conditions are still tough enough out there. That is, the economic conditions are such that we still have to keep interest rates low in order to achieve those objectives.
And then theoretically, wouldn't these very low interest rates be a benefit to a younger generation that typically is borrowing, starting a household, investing in college education, that when you're younger, you're more of a borrower?
So, yeah, I think that the people who are benefiting from this, there's multiple groups. I mean, if you had a long-term annuity, okay, which many seniors do, inflation's run very low, as I just described. So you actually, if you have a long-term asset, you've benefited. If you owned stocks, you've benefited, I think, from the Federal Reserve's policies of keeping low interest rates low, because that tends to push upward on stock prices as well. If you've owned a house, low interest rates have been supportive to the youth. So, I think our policies actually, it's hard to sort out how older people in particular are being affected by the Fed. I was looking at the data earlier this week, and if you look at the distribution of consumption expenditures across by age, actually no one's done particularly well over the last 7 years, to be clear. But people who are 65 and older have done better than the average household in the United States, actually significantly so. And I would attribute a lot of that to the fact that you tend to be, the people who are 65 and older are holding these assets that I just described, and our stimulus is providing upward pressure on that. We have not been as successful as we'd like to help younger generations. The main way to do that is provide jobs, and we have not been able to do that as effectively as I would have liked to have seen.
So, another question, and this feeds right off of it. What can the Fed do? And to some extent, because of the position that the Fed has in the economy, that question comes up a lot. What can the Fed do about income inequality and the economic disparities?
Yeah, again, so I'll come back to our objectives, which are to promote price stability, promote max employment, They don't say anything about inequality, and so our job is to use the tools at our disposal to hit the goals that we've been given of keeping inflation at 2% and promoting max employment. With that said, I think promoting max employment would be would work in the direction of reducing inequality in America. I think that one of the real challenges is for people who have not been able to find work for a long period of time. That definitely contributes to inequality in the United States. And if you're not able to find jobs, if you're forced to take low-wage jobs, all of this is a challenge in terms of, for those who are concerned about high income inequality. So the best thing we can do is provide accommodative policy by doing. Now, we're not doing that to combat inequality, to be clear. We're doing that to promote max employment. But that will help with inequality.
And does the trend in inequality concern you?
There's multiple trends in inequality. We had an annual report essay that came out in 2014 on inequality. And it emphasized a different kind of inequality you usually hear talked about. It emphasized the gap between the households in the middle of the income distribution and those in the bottom fifth of the income distribution. And that gap has been growing over time. That doesn't get as much attention. I think that gap is a sign of educational opportunities not being equated as being available as I think we need. I think it's a sign that we're not being as effective as we can as a country to take advantage of the potential of our citizens, this kind of inequality. The other kind of inequality you hear about is the top 1% versus the bottom 99. And this is being driven by different kinds of forces that I don't fully understand, to be honest. And I'm not sure. Some people are very concerned about that. As an economist, I'm still struggling to understand if I should be concerned about that or not. I feel I have a better handling on the gap that's been growing between the middle of the income distribution and the bottom quintile, the bottom 20%. And I think that represents opportunity for improvement in our country for providing more educational opportunities in an effective way.
So when we go back to the Fed's balance sheet, this $4.3 trillion. So what happens to this Fed balance sheet if inflation runs at, say, 3%, or let's say inflation runs at 5% or 6%?
Well, inflation's not going to run at those numbers because we have a target of 2.
There might be a lag.
No, but let me answer the question. I'm going to turn the question a little bit on it. Suppose we had to raise interest rates a lot in order to achieve our objectives of keeping inflation at 2%. So as opposed to thinking about inflation running at these high numbers that it's just not going to happen. I'm going to instead pose the question. Right now, in order to hit our objectives, we have to keep interest rates low. In fact, we're keeping interest rates low. We're still not hitting our objectives. But we could imagine circumstances, in the mid-2000s, in order to hit our objectives, we had to have interest rates much above 400 basis points above where we are now. So what's going to happen at that point? So what's going to happen is the Fed is holding a bunch of long-term assets. It's getting coupon payments on those assets, but its liabilities are deposits or reserves held by banks. Right now, we're paying very little to those banks. If we raise interest rates, we're going to have to pay a lot more to those banks. What that's going to do is, right now we're making a lot of money off the fact that we're receiving coupons from those bonds and paying very low interest. We give all that money back to the taxpayer. We gave back nearly $80 billion last year, and we've given it back like that in the past. We're going to be giving back a lot less. That's going to shrink over time. This is not a sign that we did something wrong. In fact, it's exactly what the point of the policy was to say, look, we'll take the interest rate risk off your balance sheet, private sector, so that you feel safer about investing. We'll put it on our balance sheet instead. Well, then when interest rates go up, we have to take the risk, and it gets passed on to the taxpayer. So that's what's going to happen when interest rates go up. When we have to raise interest rates to hit our goals, we'll do that, and we will shrink the remittances that go off to the Treasury as a result.
So the Federal Reserve is an independent institution. I mean, obviously within the system, and be able to be appointed by Congress, but it's considered an independent institution. After the experiences of the past couple of years, do you feel the Fed has too much power, too little power, mean, how to think about, there's been growing concern that this independence, which was seen as a good thing, away from political interference, but now is the Fed too powerful?
So, the Federal Reserve is a central bank that's endowed with a lot of different authorities. And, on the monetary policy side front, the concerns I've heard are often, and I hear it less now to be honest, but concerns I heard were that the accommodative policies we're providing to stimulate the economy might generate too much inflation. We just haven't seen the inflation. So I don't think there should be any concerns about our having too much power on the monetary policy front. If you go back further in time to 2008, I think that there were concerns about the way the Federal Reserve was able to intervene in the economy. In particular, the Federal Reserve was able to provide assistance in the acquisition of Bear Stearns in March of 2008. This is all now long ago history, and then also provided assistance to AIG. I personally felt uncomfortable with these interventions designed to rescue a single firm, and Congress has taken that power away from the Federal Reserve. Now we can still do market-based interventions, so that is to support if there are illiquidity problems in a market.
Right, so the market's like grind to a halt.
Grind to a halt. That happened in 2008, 2009, and the Fed, I think, did a very useful job of providing assistance in that context. I think that a lot of citizens were concerned about our ability to what apparently was an ability. It was done for the reason of to help the economy, but appeared on the outside to be picking and choosing, and Congress took that power away, and I think that was a good thing, and I feel comfortable with that.
So, this question, labor force participation rate. So, in quick definition of labor force participation rate.
So you look at the whole population, and the Bureau of Labor Statistics asks people, households, every month, are you working? If you're working, you're counted as employed. But if you're not working, then they ask, have you looked for a job in the past 4 weeks? And that second group that say yes to that question are called the unemployed. And the people who are in the labor force either have a job or they've looked for a job in the past 4 weeks. That obviously leaves out a lot of people, right? But that sum is then called the labor force. And the labor force participation rate is then the people that fraction of the whole population that either have a job or have looked for a job in the past 4 weeks.
So it's gone from about 67% in 2002 down to 62.7 today. So has the Fed been able to determine what portion of the decline is due to some form of structural unemployment, and you'll define that, and yes, exactly. That's why you get to answer the questions.
Yeah.
What portions of the decline, though, are due to other factors?
So I think that I think there's general agreement that a noticeable amount of this decline is due to demographic effects, and in particular that the fraction of our population that is of an age that we would normally think of as being retirement age has grown over this time period, and that will push. Then more people in this group of the population as a whole will be answering, no, I don't have a job, and I didn't look for a job in the past 4 weeks, and that's just totally natural. That I think would be regarded as a structural change in the economy, is that we have this demographic change. So I think a large fraction of this decline can be attributed to that. How much exactly? Honestly, it turns out it's still a matter of dispute. Even just the demographic effects are more complicated to sort out than you would like. And then there is the question of a number of people left the labor force during the course of the recession and the very slow recovery. And the big question is, if the economy were to improve enough, would these people come back? Let me pose it in a way I like better. What wage increase would it? Obviously, if wages went up enough for them, they would come back. The question is, what wage increase, what inflation rate would it take to bring them back? And if it take a very high wage increase, wage growth, and a very high rate of inflation, then we have a structural problem. If it takes a relatively low one, we don't. That's, I think, still an open question.
I think one of the things I always find a little bit confusing. So you interview business people, and they say, I can't find skilled workers.
Yeah.
There just aren't these skilled workers. And my always question is, well, what are you paying them? And at what wage can't you find the skilled workers? But in a place like Minnesota, which has traditionally had a skilled labor force, an educated worker force, but I'm sure you've gotten this message a lot about we can't find these skilled workers. So how do you sort out that?
It's, you know, you have this reaction. Certainly as an economist, I've had that reaction too. I think the reaction being, well, if you can't find workers, you're not paying enough. You know, if you start to pay more, you'll find workers. But I think it's just more, and this is one of the institutional issues that I mentioned at the beginning that I've had to come to grips with more, that it's more complicated than simply saying, okay, let's go out and pay the new workers 50% more. Well, you've got a whole pool of workers you're already working for you, maybe doing jobs that are quite similar. Do you want to raise their wages too? And so there's a bunch of forces that make wages a lot less flexible in responding to economic conditions than I would have anticipated. Having said that, wages do respond to economic conditions. If you want to go, well, as of June of 2014, if you wanted to go work at McDonald's in Williston, you would have made a lot of money.
So this question is right off the news. What impact do you believe declining oil prices will have on the region and on the economy as a whole?
So I'll start with the economy as a whole. Chair Yellen referred to the decline in oil prices as being a tax cut for the economy. And that's a good analogy. I think that it puts, for most people, what it means is I don't have to pay as much for the gas I need for my car. That puts more money in my pocket. I can go do other things with the more discretionary money. And that will stimulate, I think, more demand for U.S. goods and services. That's a good thing, basically, for the U.S. economy. In our region, there's been a lot of attention, of course, to the oil boom in Western North Dakota. You know, that's a very important economic event. We track it very closely on our website. But even in the context of the 9th District economy, this is not, the fact that there are going to be some challenges there, and I'll talk about those in a second, is not going to be that material for growth prospects in the 9th District as a whole. But if you get into the state of North Dakota, you start to get down smaller and smaller, and you get down into what's going on in the Bakken area itself, the decline in oil prices is going to have an impact on drilling activity. That will be most material because that's the first thing that you'll see slow. And it will have, I think, an impact on rate of production. What impact it will have on things like wages, what impact it will have on prices and incomes, it's a little early for us to make those prognostications. One issue is how persistent will this decline be, and that's hard.
Now, have you been surprised? Because typically when oil prices come down, everyone cheers. This is a good thing. You can drive, as you say, you can drive to the gas station. It's cheaper to fill up your car. This time around, decline in oil prices, there's been a lot of worry that this is signaling some sort of a downward spiral.
Yeah, it is a little bit different, and I think it's because that the decline in oil prices is linked, at least somewhat, to uncertainties about global economic activity. So the U.S., I showed the pictures about 2014. I think there, as my remarks indicate, I think there's room for improvement in how we're doing. But that's grading on an absolute standard. If we grade on a curve, the U.S. looks very good compared to other countries around the world. And I think there's a lot of uncertainties and concerns about the decline in oil prices represents a realization that maybe global demand prospects, global economic prospects aren't as strong as people had thought. That's funneling through to our economy, not so much through direct trade effects and how much people demand our goods and services, but rather through financial markets. So people are uncertain about what's going to happen in the global economy. They run to a source of safety, and that's U.S. Treasury assets. And that means that, as I suggested earlier, that puts pressure on us to provide more accommodative monetary policy conditions in order to hit our objectives, because everyone wants these valuable U.S. Treasuries. And that's been the surprise is, boy, the decline in oil prices has really been associated with a sharp decline in bond yields, which represents that people are in U.S. government bond yields. And it's associated with the fact that I think people are uncertain about the future.
So you said, and on a relative scale, the U.S. looks really good.
Yeah.
I mean, we are growing. Now, can the U.S. continue to have this kind of expansion? I mean, find the labor market appears to be doing a lot better.
Yeah.
But, Europe is having its problems. Japan has its problems. You're slow down in the emerging markets. Brazil has issues. China. Can we continue to? Can this acceleration be maintained?
The fundamental impulse in the U.S. economy is domestic. We are certainly global prospects matter for us, and we take those into account when we do our forecasting very carefully. But at the end of the day, the fundamental impulse for the U.S. economy is a domestic one, because trade is a relatively small component of our national income picture. I think that our biggest challenge for us then, from as a monetary policymaker, the thing I worry about most is not really the global risk factors, but rather that we are sufficiently patient about keeping the target range for the Fed funds rate low. I worry that by going too early on that, we risk slowing down growth that we could otherwise have. We risk losing employment growth that we could otherwise have.
Okay, so the next question is, so why can't we live with a 0% inflation target? I mean, where'd the 2% come from, and why not make it 0?
Well, there's a great story in the New York Times about where 2% came from that I won't go through, that was written by Neil Irwin a couple of weeks ago, and I encourage you to read it. I'll just explain why 0 won't work. And so 0% won't work because the long-run rate of inflation, why it really matters to us as monetary policymakers is that it shows up in the long-run level of interest rates. So one portion, if the long-run level of inflation is low, then interest rates will tend to be low because people don't need to be paid as much in terms of interest to compensate them for the fact that inflation is running too high. If inflation is high, then they need more. Those of you who are getting older and older relative to the crowd, but those of you who remember the 80s, you'll remember that interest rates were really high back in the early 80s. A large part of that was to compensate for the fact that people expected inflation to be really high. Now, so if we're keeping inflation at 0%, long-run interest rates will be low. That gives us less capacity with which to help the economy when we have a bad shock. So a big problem for us, which we talked about, is we couldn't make interest rates below 0. So if we're keeping interest rates at 2% over the long run, that gives us less room with which to help the economy if there's a bad shock. So I think of that as the main issue is we have to keep it at 2, something above 0 in order to provide that buffer. And if you go back to read about, Chair Yellen was actually, when she was as a governor on the Federal Reserve Board back in the 90s, really pushed hard for something like the 2% number we have.
And then why are we seeing deflation, which really isn't a term you hear much about it unless you read the history books. You talk about the Great Depression. Now Japan's had its deflation, Europe's having its deflation. What's going on?
Yeah, the challenge is that you have a sufficiently severe shock to the economy that pushes downward on demand, and that pushes downward on prices. You use your tools that are available to you, and then people begin to perceive that you, that is the central bank, are either unwilling or unable to do more. And that will lead them to worry that prices are going to keep falling, keep being low, and then that's what leads you to get stuck in quote-unquote traps. Like the Japanese experience is really the leading experience on this in modern times.
So just explain it. So when computer prices keep going down, we all cheer. So we're used to that. So deflation in computer prices, we say that's a good thing, or in the information economy. But as an economy overall, you don't want it.
The reason you cheer about computer prices is that for most of us, at least, when computer prices go down, our wages don't go down with them. And so that means it's easier to buy computers. In the Japanese case, I was talking to, when I visited Japan earlier this year, and I was talking to somebody about the recent Japanese experience. So the Japanese experience is that they had very low inflation. How low, I'm going to explain in a moment, for 20 years. And now they're starting to see inflation. They have a word in Japanese, which I don't remember, and I won't try to resurrect it out of my memory.
Level set.
For increments, wage increments. And this person I was talking to, a younger employee, came to him and said, what is this word? Never had a wage increase before. Why? Because inflation was low, and so wages were stuck for 20 years. So that's, when computer prices go down, it's great. Unless you work in the computer industry, but if you're then you're able to buy more computers. If everyone's wages and prices are all going down together, that's a problem.
So this next question is, what do you feel is the best measure of inflation? And how well do you believe the current CPI, Consumer Price Index calculation, reflects actual conditions for consumers?
I think it's pretty good. We use, as I indicated earlier, we use a slightly different measure, the personal consumption expenditure inflation rate. I think from an economic point of view, that does do a better job. It tends to run a little bit lower than the Consumer Price Index.
They kind of track each other?
They track each other pretty closely, but there are gaps that open up that are measured in 0.1, 0.2 kind of percent. You wouldn't notice it unless you were looking pretty closely. Yeah, but I encourage people to look at the fine details of the Consumer Price Index report that comes from the Bureau of Labor Statistics. You can see what actual prices are moving. The Billion Price Index that comes out of MIT, that's not a government produced thing. You can start to, if you have a skepticism about the government produced numbers, you can back it up. There's lots of private sector kind of reports now to try to back that up.
Well, there's always these theories that the CPI is being manipulated, that it's not a real index. It's, it changes over time, and therefore it's been running a lot higher or a lot lower, depending on what your argument you're making.
Yeah, I mean, those people don't know the people who actually work in the Bureau of Labor Statistics are totally committed to one thing, getting that number exactly right. That's their job. That's their life.
Yes, exactly. Chairwoman Yellen recently said that falling energy prices, as you mentioned, good for the economy. Yeah. So the questioner would like to know if energy prices are the exception to the rule of her desire to create higher prices through inflation.
Yeah, again, it comes back to this issue that, first of all, this is perceived to be a short-term fall in energy prices, and it's not something that's going to be persistent over time. And so that's one reason why she's not as concerned about it from an inflationary point of view. The other reason is that, and relatedly, we're not all going to get cut in wages to correspond to the fact that gas is cheaper. And so this is why it's quote unquote found money for us, is that our paychecks go further because gas prices are lower.
Well, I'd like to thank you very much.
Oh, thanks.
And this has been fun. We could
great.
keep going, but I think you might all want to go for the refreshments that are going to be out in the lobby there. And thank you very much for your time.
Yeah, thank you.